Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
Welcome back, ladies and gentlemen, to the Family Banking Show. We're your hosts, Derek, Rob, and John. Guys, how are you this week?
Doing well, Derek. Coming off some big news. It's November 6th we're recording, right? So, yeah, pretty crazy, honestly. Having a decision. I feel like there's been so much anticipation one way or the other, no matter who you are. And it's kind of nice just to have like a final, way ahead.
Yeah, that's for sure.
And my parents reminded me the best thing about the day after election night is there's no more political ads for a while.
Yeah.
It's just people get so sick and tired of watching that on TV, but yeah.
Get back to the random diabetes medicine ads and never apply.
Yeah, you'll get your Wells Fargo, hey, you can get your line of credit for 0% interest for 12 months, It'll just switch all to the Black Friday ads if they haven't started already. We try not to watch too much TV, but yeah. Well, guys, this episode we're going to be talking again on kind of infinite banking mechanics, the basics of IBC. Specifically, we're going to focus in on policy loans, what they are, why would a client want to take a policy loan versus a loan from maybe a commercial bank. So John, why don't you go ahead and start us off? Talk to us a little bit about the nature of the policy loans and just give a brief definition as to what it is so that our clients are caught up to speed.
Yeah, so this is the fun way that we access our cash value in a whole life policy to become our own bank, right? So we are technically taking out loans within our own banking system, collateralized by our death benefit, right? And so the nature of these policy loans really, really matters. It's unlike any other loan that I've ever seen, that I've ever heard people ever that gives you tons of advantages over any other product. So what it is as you continue to pay into your premiums, right? We've talked about this over the past many episodes. You're building a cash value, right? And that cash value is the equity that you can access in your whole life policy to borrow against. And it's really important to understand that term, borrowing against, rather than withdrawing. And we'll talk about kind of the reason we do that a little bit later. But we are borrowing against to not interrupt the growth of that cash value for the rest of its life, and taking this loan, right? And this loan is taken not from your cash value, but from the life insurance company's general account. Because it's their money, they're going to charge an actual interest to that loan, right? But it's unlike any other loan in that, one, it serves as a line of credit, right? It's not like a car loan or a mortgage where you make a payment back into it and you never see those dollars ever again, right? It's more like a credit card or line of credit where you pay something back, you have immediate access to those dollars that you just paid back, right? Another big component of it is I like to call it like simple interest on steroids, or the best simple interest possible, because it's not something that, one, it's never due, right? You're never going to get like a knock on your door saying, hey, your interest is due plus your minimum payment, XYZ. No, you are the owner of this policy loan, where, interest will accrue over an entire year. And then at the end of the year, you as the contractual owner of this policy loan too, have the option to pay the interest only, to pay principal and interest, or to just roll that interest that accrued over the year into the next year, right? So you have all the flexibility and the options in the world with this policy loan. Some other components are For us, it takes either 2 or 3 clicks online or just one simple 5-minute phone call, and it's going to show up in our account within, 2 to 5 business days, or generally it's like 2 or 3 from what I've experienced. But they don't ask your credit score. They don't ask what you're using it for. All they ask is, how much do you want and where do you want it sent, right? You can do a check, you can do electronic funds transfer. So it's the easiest, simplest, low stress, like, right? You don't have to like draw blood for this. Like, you don't have to, explain why you move money from one account to the next, lots of advantages to it. And this loan just gives us tons of flexibility, right? Like any other loan, we're required to pay whatever the bank tells us to on a either monthly, quarterly, yearly, whatever it may be basis. But we are the banker and we control the terms there. So the nature of it, I think, really matters, right? When understanding like what am I getting into with IBC and what am I getting into with, okay, like the way I access this is through a loan. Like I don't like that word, right? Lots of Dave Ramsey, followers, and just generally people don't like having tons of debt or loans outstanding to their name. So we want to maybe clarify what it looks like and how much freedom and flexibility you even have, despite it being technically a loan.
Yeah, like one of the really great aspects of it is it's private. It's between you and the insurance company. It's a contractual right that you have as a policy owner, a mutual policy owner. You have the contractual right to take a policy loan whenever you want, up to, basically up to the account, cash value you have in your account. But another like really cool thing, because I've done this, I've used many policy loans for many different things, house projects, taxes. I paid taxes taking a policy loan one year. It's just so flexible. Bought a pontoon with a policy loan. But one of the cool things, yeah, I didn't really realize until the moment I did it when I bought the pontoon, like because we're also just not used to doing this. Like everyone says, you should buy things with cash, right? Well, when you take a policy loan and you walk in and buy a car or a pontoon or a thing with a title on it, you get the title. Like you own it. It's the insurance company doesn't have the title on the pontoon. I have the title on the pontoon because I paid with cash. And that was just like oh, this is cool. Like I've usually, whatever, I buy a car or something and the bank owns it and I pay them for the right to use their money, but then they own it because it's the collateral against the loan. Well, the collateral in this case is my death benefit. So the insurance company doesn't, like John said, doesn't care what I'm doing with the money. And when I go and buy something with it, if it has a title, I'm the owner of it. And the other cool thing is it's private. So it doesn't show up as a debt to income ratio. Like, so if I decide that I get a pontoon and I want to, it's a $75,000 pontoon or something, it doesn't, there's not a $75,000 debt in my public ledger that can be held against me. And so it's just there's so many benefits to it that I don't think that people aren't aware of. And that's why we're doing this fundamentals kind of series, is to talk through like some of the amazing benefits of policy loans. And if you have, with a correctly designed policy that helps you get the death benefit protection plus the cash value early, you can start leveraging that cash value for opportunities, for emergencies, for cars, for large purchases. So it's just such a flexible tool and a really great benefit to an infinite banking style whole life policy and your family banking system.
Great. Guys, I got 2 follow-ups to that. Rob, we'll start with you. You had talked about that you can access the cash value almost up to the account value. I think that the best way to describe it is you have access to about 90% of your accumulated cash value in your policy. Why would the insurance company not write loans for the full 100% of the cash value?
Well, the insurance company builds in that buffer so that It protects the policyholder from getting themselves in trouble. So they don't let them take out the full amount of cash value and really stress that policy out. And then also it's a good protection. So, there might be interest accrued. It gives the insurance company some options to help keep the policy in force. So it's a protective measure that the insurance company, why they have that in there, that you can't take 100% of your cash value.
When the insurance company, why is it so significant that the insurance company would charge interest on the policy loans? Why are they doing that to their policy owners? What's kind of the mentality behind maybe the way that they set those rates? Help us to understand why the insurance company is charging interest on policy loans.
Yeah, we should be happy the insurance company charges interest, right? The big reason for that is that we want our insurance companies to be profitable because we are part owners, mutual owners in these companies, right? So anytime we get a dividend, that's a direct reflection that our company is profitable. And the companies we write for over 120, even 175 plus years, but they're paying these dividends as a result of being profitable. And part of the profits they receive are through policy loans, right? Like banks are profitable because of, largely due to the amount of interest that they receive in profits on the dollars that they're loaning, even if it's not their own money. But we'll talk about that maybe in a different episode. But these loans help the insurance companies have a profit on what they're loaning, like I said, out of their general account, out of their funds that we get to pay back while still receiving the profits. So the way I honestly see it, and maybe the math isn't always exactly this, is pretty much like a net wash, like a net zero of like I'm paying back interest, but I'm receiving dividends and profits and increases on my cash value at the same time, to where it's as though it feels to me as though I'm withdrawing, but still getting full access to my entire cash value and having full control over the entire equation. So we want our companies to be profitable, and we want to pay above and beyond even the interest that they charge, because that is an asset, or like a profit generating activity for the insurance companies.
Excellent. Guys, talk to me a little bit about paying interest back. I mean, we have the option to pay it back. We have the option to not pay it back and allow it to accrue. If we only paid the interest back, it basically acts like an interest-only loan, right? Much like you see as kind of some advertisements on when you're watching TV of interest-only payments. And why is that maybe a good strategy? Why would somebody want to look at just, the cost of financing as being just the interest paid on policy loans?
Cash flow. That's what I love about it. We love permanent mutually owned whole life insurance policies because they give you so much control and flexibility over your finances. And it's such a cool feeling. And it's something I don't think people quite get it until they do it with a policy. Like when you take out a policy loan, and I've even suggested to clients, just take out a loan. Just take a loan out, buy something or not, and then just don't pay it back for a month or 2 months or 3 months or whatever. Just don't pay it back. And then just pay it back. Like it's like this epiphany moment when you have this loan out, and then you're like, oh, it's 1 month later. Oh, wait a second. I don't have to pay this back. I can pay it back when I want to pay it back. It just is really like the veil gets like lifted, like, wow, I have total control over this money. I can pay it back on my own terms, on my own schedule, or not pay it back for 6 months because I know I have a bonus coming. It's like the flexibility. And then let's say you take out a loan for something and you are being an honest banker and you create your own amortization schedule, which I'd say that's a smart play. Create your own amortization schedule, your own payback schedule. But then an opportunity comes up And you're like, well, I was going to pay in $600 a month because it was like, $450 in principal and $150 in interest. I'm just going to take that 450 and apply it to something else and just pay the interest off each month, or don't pay the interest off for a whole year and just pay it off at the end of the year. You have that total flexibility that you can now control cash flow on your own terms in a way that you just didn't have the possibility to do before. Because when you're the banker does what he wants to do. And so if you have a policy loan out, you have all the flexibility in the world to pay it back at your terms or not, or to do it strategically. And it's really just an epiphany moment when that clicks in a policy owner's head.
Yeah, I think that's even, super practical for somebody who's maybe an independent contractor or, just a solo entrepreneur, somebody who's maybe their primary source of income is through commissions.
Yep.
Why do I say that? Well, because most banks hate giving money to somebody who's commissioned, an independent contractor, or just a solo entrepreneur, because they're afraid that your income is going to be so inconsistent that you're not going to have the finances available to service those loans. But by partnering with an insurance company, you don't have that drawback in their opinion. They're totally okay with you taking out those loans because it is collateralized. So you can do just interest only, or, when you get that big commission check coming in or that bonus at the end of the year, you've got those funds then to service those loans, but you've been able to delay that for a certain period of time, or maybe just pay the interest only instead of having to pay down the principal. So yeah, great ideas there. Talk to me a little bit, guys, about withdrawals versus loans. And we're going to split this up. We're going to talk about it when you should take a withdrawal or a loan before you reach retirement age, and should you take withdrawals or loans after retirement age when you're looking at this as a source of passive income. So John, why don't you start us off, talk about leading up to retirement age. Should you take withdrawals from the policy or should you take loans?
Yeah, so one of the wonders of the world, according to Einstein, is compounding interest, right? The eighth wonder of the world. And then the ninth, I guess, is the uninterrupted. And that uninterrupted is the star of the show, in my opinion. Any other concept of using money, of saving money, growing money, anytime you need those funds, like, it is amazing to talk about, yeah, if I can get a 10% rate of return for 30 years, I'll have, quadrupled my money. And then from there on after, I'll have like 2 to the power of whatever. Like, that's all great if you don't ever need it, touch it, or like have an opportunity that comes across, or need to finance the things of life, all the things that every single person in this world has to do, right? So in those cases, then you interrupt the growth, right? You no longer reap the benefits of the compounding. You no longer, see your dollars go exponentially up, or hockey stick, or whatever other curve you want to talk about. Like, it's all just going to be this interrupted curve, and then interrupt again and interrupt again. So and plus, when you then use those dollars, you have to pay taxes on the gains, right? So here we know our dollars are growing at a guaranteed rate. Like, it's never going to reduce in value. We're always going to see it grow far beyond, especially over a long term, far beyond what we've put into it. And in order to not interrupt the growth, maintain the tax advantages, and by tax advantages, I mean accessing it tax-free, because it is technically a loan, right? Nobody's ever been charged, taxes for a mortgage that they received as a, ordinary income, right? And so the same applies to these policy loans. So, especially in our younger years, no matter when you start, and I'm talking younger years of the policy, like years 1 through, we'll call it 20 for ease of talking about it, is we want those dollars to continue to compound and not touch it, right? Not interrupt it. And so past 20, even 30 years, that 20 to 30 year mark, is huge to see these dollars really take off, really start to compound. And you get to reap the benefits of it all without having to interrupt that growth, right? Using these policy loans, borrowing against it, while in parallel, it continues to grow. And, like the two, just a quick aside here is like the two main categories I like to set for myself of when to use a policy loan is so that I can get a return on my money or a return of my money, right? A return on my money is if I see a property or some investment that I am very confident I'll get a rate of return, then I will use my cash value to take advantage of that opportunity and replenish my policy loan and continue getting that extra cash flow and continuing to multiply cash flow, really. But then return of my money is anything that I otherwise would have used a bank for and pay them interest and, make their banks profitable. I would return my dollars back to me and profit the same way that banks otherwise do, which Nelson Nash talks about. It's 34.5% of every after-tax dollar over our lifetime. So I want both, right? And I'm able to do both with my cash value. So definitely in the first, 20 to 30 years, I would say it is more often than not advisable to use a policy loan rather than withdraw. So you don't interrupt the growth and you can continue to have those $1 in the early stages compounding over a long period of time.
Yep. Rob, talk to us about in passive income years, what's the strategy there between withdrawals and loans?
Yeah, so passive income years, the strategy flips because at that point, you don't have your income that you might have had that you can pay back your loans and over those first 20 to 30 years. So the smart strategy at that point, because what happens then is if you're taking the loans out, as income, but you don't have the income to pay them back, you start getting charged interest on your loans each year, and that starts to snowball and eat away at your cash value, quickly, and reduce death benefit. And so the smart play there is to take withdrawals out that up to your cost basis so that you're getting money out for passive income tax free, but you're not getting that compound interest accruing while you're doing that. So then when you use up to your cost basis to stay tax free and still get income, then you start taking policy loans against your policy's value so that you can then still have that income, for all those years in retirement.
Rob, can you clarify cost basis for anyone who might not know that term?
Yeah, and then cost basis is the amount of premium you've paid into your policy. That's your cost basis. And when you look at an illustration, it's crazy when you see how much cash you put in versus how much cash value and death benefit you have. So the first thing you'll notice is you've put in way less premium than what you're getting out in a properly designed infinite banking style policy that Derek and John and I know how to do and been trained to do. You will be amazed at how much cash value and death benefit you will get versus the amount of premium you've put in. And that amount of premium you've paid in over those years, that's your cost basis. So that's the amount of money you can withdraw tax-free up to that point. So if you've paid in $300,000 in premium over 30 years, you can take up $300,000 out in passive income and not pay any tax on it. At that point, let's say you have like maybe $400,000 or $500,000 in cash value still available. You can start taking policy loans against that up until that cash value is used up. And if you kind of set it up correctly and plan it right, that will be at the very projected end of your life, so you can have this tax-free passive income, till the very end. It's really a cool process.
All right, guys. Any other thoughts about policy loans here before we end this episode?
I would just say, like, always referring back to what are we comparing it to? Any other scenario, you're either interrupting growth and having to pay taxes probably on that growth, or you're getting a loan from a bank where they're going to underwrite you, they're going to ask your credit score, and they're going to do all sorts of tests and DTI calculations and everything to make sure that you are a lendable, right? And then even so, they're going to set the amortization schedule. Say to the bank are going to owe $500 a month. If you just apply that number to the same policy loan, same amount, you'll probably pay it off in like 3 years, just by the nature of this like supercharged, simple annual interest feature of it. Plus, you get access to all those dollars again. So any sort of comparison, and I'd be open to hear anybody who thinks that they have a better comparison, and I'd be, more than happy to learn. But we've done tons and tons of research, and there is just nothing that even gets close to comparing the ownership, the control, the flexibility, and the access that you get to your dollars all along the way. It's really amazing. It's amazing.
All right, guys. Well, thanks again for chiming in on this episode, and I hope our listeners enjoyed our conversation. If you're interested in learning more about how to start your own family banking system, you can reach out to us at thefamilybankingshow@gmail.com, and we'd be happy to sit down and schedule some time with you. In our next episode, we're going to return to our faith and finance series, talking about, is it biblical to leave an inheritance to your children or grandchildren? So, guys, looking forward to that, and we'll see you in the next episode.
You guys.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.